Welcome to Dorsey and Whitney's webinar on the PPP and other CARES Act stimulus relief, the revisions. I'd like to introduce Jamie Whatley, Dorsey's Dallas office co-head in the Finance and Restructuring Group. Jamie?
Wonderful. Thank you all so much for joining us. We have wonderful Dorsey speakers today. They help navigate our clients through the CARES Act and the original PPP. Ken Logsdon, he's a partner in our Utah office representing banks, financial institutions, and borrowers. Joe Lynyak, he's our regulatory and banking partner in our LA and DC office. And Matt Olson, our bankruptcy expert from our Palo Alto office. Our program will be 60 minutes today, and the slideshow is available on the Dorsey events at dorsey.com. Given how much materials we're going to cover today, I don't think we'll have time for questions, but please feel free to reach out to any of your Dorsey contacts, and all of the information on the speakers is in the information at the end of the presentation. We have a great agenda today. Joe Lynyak will cover the extension and revisions to PPP, the new second draw PPP, the much anticipated second draw, amendments to other SBA lending programs, and the possibility of legislation by the new administration. Ken Logsdon will cover the status of the Main Street Lending Program, as well as practical considerations for the second draw PPP and other legal issues. And Matt Olson will cover bankruptcy revisions and foreclosure moratoriums. Joe, I'll turn it over to you to get started.
Oh, well, thank you very much, Jamie, and welcome everyone. I hope you and your families are safe and healthy. On my piece, I'm going to go over the parameters of what's changed with PPP. And as Jamie mentioned, Ken is going to follow up with some emerging legal issues to give you a heads up as to what you may be thinking about. But starting off in December of last year, the Congress passed the Economic Aid to Hard-Hit Small Businesses, Nonprofits, and Venues Act. Normally they try to come up with some cutesy acronyms such as "We're Here to Help You" Act or whatever, but in this case, it was not. They weren't able to do it. But it was Title III of the 5,500-page Consolidated Appropriations Act, which is the omnibus bill that funds the federal government other than the armed forces. So we're talking primarily here about what was in Title III. And it was, as you recall, the former president fussed around a little bit as to whether or not he was going to sign it. He finally did on December 27th. And in Title III, there are 48 separate provisions. And if you were teaching law school and a course in legislative writing, you would flunk anybody who wrote this act. It's almost incomprehensible. It's very poorly written. It just jumps around everywhere. And so what we're going to try to do here is put things in the various categories in order to help you understand what was adopted and how it all fits together. Going back a little bit, when the so-called original PPP was created, if you remember, it was exhausted within a couple of days. $320 billion went out the door. And then they added another 300 odd billion dollars, which surprisingly was not all used. And this act in Title III adds additional amounts to the remaining amounts that were available in August of 2020, for a total amount right now of the total PPP program of $806 billion. And it'll be very curious to see whether or not all that amount of money will be tapped. But also note that in addition to this amount of the 806 billion, other SBA programs also had additional amounts added to them. Next slide. Thank you, Jamie. Giving you a 10,000-foot summary of PPP, the Act extends and continues the origination authority for the PPP from August 8th, when it originally terminated, until March 31st of this year. And what that means is that new PPP loans can once again be originated. What it also does, it creates a second draw program, which we're going to refer to as a second draw PPP, for smaller eligible entities, not the larger ones under the regular PPP program, what for smaller entities with 300 or fewer employees, you've got to demonstrate the fact that you've had losses in 2020 or 2021 as compared to 2019. So there's a revenue requirement that has to be shown. They reduced the maximum amount you can obtain to $2 million, and you had to have first received a first draw PPP loan. In addition, the Act amends many PPP rules for loan applications and loan forgiveness, most of which we're going to be going through. As to the original PPP program, it remains essentially intact. Eligible persons and entities may once again apply for a PPP loan, and if you hadn't done so before, head down to your friendly neighborhood bank or credit union and apply for one. Now, what they did do is they said that, gee, we don't like the idea that rich companies, which I guess is acquainted with being registered with the SEC, they prohibited SEC registered companies from now obtaining a new PPP loan. And other minor adjustments were adopted by the Act, but essentially businesses with 500 or fewer employees will continue to qualify for funding up to an amount not exceeding $10 million. But of course, since we're dealing with the SBA, there's always an exception to the rule. And what they did is they put in a caveat that if you have got an affiliated group of companies, commonly owned or controlled, the maximum amount the affiliated company group can obtain, even though they may otherwise qualify for individual PPP loans, it's now capped at $20 million. Now, the second draw program, which has really been highlighted in a lot of media reports, is that there's a new program, the second draw PPP, which authorizes the origination of new PPP loans to smaller businesses with a maximum loan amount of $2 million. It's only available to borrowers who have previously received an original PPP loan. And what that means is if you didn't get one the first time, go get your original PPP, because actually the lending terms are more liberal than this one. And eligibility, a maximum amount of no more than 300 employees for the most part. You had to have used or will use the full amount of your original PPP loan if you had received one. And there's a revenue requirement that you demonstrate at least a 25% reduction in gross receipts calculated based upon the first, second, or third quarters of 2020 as compared to a corresponding quarter in 2019. And in some cases, you may also be able to use the first quarter of this year when comparing to your operations in 2019. Now, in terms of eligibility, they slightly expanded eligibility under the second draw PPP program and also the original PPP, and who can obtain a loan. Well, just about any type of business, certain nonprofit organizations, housing cooperatives, veterans organizations, tribal businesses, and that's something that really requires some attention because there's been a lot of clarification from the SBA on tribal businesses, self-employed individuals, sole proprietors, independent contractors, and small agricultural cooperatives. The SBA also indicated very early on that entities excluded under the SBA's exclusion list, which is in 13 CFR, may not receive a PPP. But as I said a moment ago, since we're dealing with the SBA, of course, there are exceptions to to every rule, and nonprofits and religious organizations that are included in the list of ineligible entities under their regulations may receive PPP loans. In addition, other entities are now excluded. Lobbying organizations, anybody who's got an address in K Street in Washington, D.C., entities representing certain foreign governments, including the PRC. And by the way, there is some discussion as to whether or not that applies to the original PPP loan, so you need to be looking at that. But it is clearly a hot button as put into the act. Entities affiliated with certain governmental officials. So if you're in the executive branch of the federal government, you may not be, your related entity might not be able to obtain a loan. SEC registered companies that I mentioned a moment ago. And then there's another program which we'll touch on briefly, the Shuttered Venue Operators Grant Program. And those entities receiving money under that program will not be able to receive a PPP. Now, the calculation for the second draw program is for most entities, the lesser of 2.5 times the average monthly payroll. And I think we're all getting pretty adept at making that calculation, or $2 million. However, there is a special rule if you fall into the NAICS Code 72, and that is you can have 300 employees per location, and the calculation of the loan amount is raised to 3 times the average monthly payroll costs, or $2 million. And for NAICS Code 72 is the North American Industry Classification System, which is the standard used by federal statistical agencies when classifying businesses and establishing data for analytical purposes. Now, the small PPP loan program was further narrowed down by creating a subcategory for small draw PPP loans of $150,000 or less. And what does it require? Well, it benefits those entities. And by the way, to digress for a moment, as you all know, over 50% of loans originated under the PPP program were for small PPP loans under $150,000. So the program actually, as envisioned, really did help small businesses. And it requires the SBA to exempt an expedited loan application and certification process. It exempts the borrowers from submitting loan application forgiveness from additional documentation, to consider whether they should allow additional flexibility for determining eligibility beyond what's in the CARES Act, with a caveat, and that is you may not have to submit a lot of documentation, you may not have to prove it for loan forgiveness, but theoretically they can still come after you and ask for the documentation. So if you're on the bank side doing loan forgiveness, you may not have to collect the information, but you may want to be warning your borrowers that make sure you have decent records in case, God forbid, the SBA decides to target you. And new forms and applications are going to be available. Well, let's go on to something near and dear to a lender's heart, and that is compensation. There's new compensation rules both for the second draw program and for the original PPP. For the second draw program, for loans up to $50,000, the processing fee is the lesser of 50% of the loan amount, or $2,500. For loans between $50,000 and $350,000, the processing fee is 5% of the loan amount. And for loans above $350,000 up to $2 million, which is the maximum amount for the small draw PPP, the processing fee is 3% of the loan amount. As to the original PPP, what they did is they ladled on one additional component, and that is for loans above $2 million, the processing fee is 1% of the loan amount. That all holds together pretty well. Now let's get on to the changes that took place under the act. And this was an opportunity which was certainly taken up by many folks in the industry to ask for clarifications on a lot of interpretations and positions taken by the SBA, whether formally or informally, that created some consternation and issues regarding how do you go about doing this and doing it properly. One of the things that they did, which I thought was a good idea, is that the act expands the categories of forgivable business-related expenses under the PPP. And now, what can you get loan forgiveness for? Well, you can get loan forgiveness for payments made for software, cloud computing, and other human resources and accounting needs, probably falling under the category of business applications. Certain property damage costs which you incurred as a result of social disruptions occurring during 2020, supplier costs that are essential to your operations, including costs incurred during and surprisingly or prior to the covered period of a PPP loan essential to your operations. And I believe that what this is referring to is, as of the date the PPP was created, before you got your funds, you're able to deduct those costs. Whether or not the SBA clarifies that as to how far you have to go back, I think we're going to have to keep an eye on. And then an important thing, because of COVID, covered worker protection expenditures for personal protection equipment, as well as capital expenditures to protect your employees. They now become expenses for which you can receive forgiveness. And then we don't have time to go into this in great detail. Would note that if borrowers did not receive loan forgiveness by December 27th, which was the effective date of the act, but you would otherwise have been able to obtain additional PPP funds because of the expanded definitions and flexibility, you can go back in and obtain those additional funds. And then also, you can also be requested to modify your PPP loan, and in certain circumstances get additional loan for items forgiven. Other things which are changes, tax purposes. Something was clarified for borrowers is that even though your loan was forgiven, it doesn't become income for purposes of the Internal Revenue Code. That's certainly a good thing. It clarifies that you had to be in existence on February 15th in order to receive a PPP loan. Some questions have come up whether or not if you had if you were sole proprietor and then flipped over into a formal corporate entity after that date, whether or not that counts, and we can talk about that later, or but it's something that you watch. Covered period. The covered period was extended, and it's now up to the borrower the choice between 8 and 24 weeks after loan origination, and it affects the period of loan payment deferral. So it's something to be watching for. Seasonal employees, and for calculations, it now means any 12-week period between February 15th and February of 2019, February 15th, 2020. Clarifies something that I think we knew all along, that the interest rate on all PPP loans is non-compounding and non-adjustable. Now, one of the things which is a good thing is, if you probably recall, that if a borrower received an EIDL loan and the PPP loan, the EIDL loan had to be deducted before you could get loan forgiveness. Well, that's been reversed. So if someone had both an EIDL loan and a PPP loan, they can apply to get the EIDL loan portion refunded as part of the loan forgiveness process. Again, we mentioned before, publicly traded companies cannot receive a PPP loan. And a couple of other things. The covered period it is extended through March 31st. And the applicable period for employee salaries of $100,000 on an annualized basis is prorated during the period during which compensation is paid or incurred. Something, again, near and dear to the hearts of lenders everywhere is, for whatever reason, for a several week period of time, the Treasury and the SBA were woofing around about the fact that there was a lot of lender liability out there, and they would be going after lenders for fraudulent behavior and a whole list of horribles, which, when you read the act and say, why do you want to do it? Number one, and number two, you really should not be able to do that. Well, the act creates a statutory as opposed to regulatory safe harbor by stating that the government cannot take enforcement action, including the imposition of penalties, against a PPP lender when the lender reasonably relies upon certification or documentation submitted by a borrower. And those are the forms that they submit as part of the application and loan forgiveness process. And what is the standard? Well, one, the lender acted in good faith when complying with its obligations regarding the loan origination and forgiveness process, and that all relevant federal, state, and regulatory requirements are satisfied. So it's pretty clear cut that it's going to be very difficult for the SBA to be going after lenders, provided that you have decent training, you've got good policies and procedures, and it's retroactive to the original PPP. A couple of miscellaneous chart changes, and then I'm going to turn this over to Ken. There's bankruptcy code provisions, with Matt is going to talk about a little while later. For farmers and ranchers, there's a special calculation for farmers and ranchers who operate as sole proprietors, which means they can go back in and apply for additional PPP funds. There's conflict of interest, which I mentioned a while ago, which prohibits granting loans to certain entities associated with senior government employees. And if the loan had already been applied for, you've got to notify the SBA when the entity who received the funds is applying for a loan forgiveness. Shuttered venue operators, this is a wonderful gift to the performing arts industry, and it's $15 billion for grants, not loans, but grants, meaning here's the money, come on down, to live venue operators, promoters, theatrical producers, live performing artists, talents representatives. Now, there is a requirement for showing that you lost revenue, which in the entertainment business is going to be very easy to do based upon last year. You cannot receive a PPP loan on or after the effective date of the act, which was December of last year. You cannot be an SEC registered company. Now, for large movie theaters, they are screaming bloody murder about that that requirement, and we will see how long that lasts. And again, as I mentioned, it's a grant, it's not a loan. Other things, farm credit institutions may now make PPP loans. There's a CARES Act waiver for women's business centers, matching. And then finally, in addition, I will note, and I mentioned this a couple of minutes ago, numerous small loan SBA loans have been, programs have been amended, increasing the amount of money available under those programs. Section A lending program, the EIDL loan program, and other loan programs. And what they also do is they also homogenize many of the requirements of these programs with that of the PPP to better align them so that you don't have to be worrying about one from column A and one from column B. It's not going to be perfect, but it's certainly getting there and will be a real help. And for those of you that are working in small dollar communities where folks need funds, this is something that you really need to do a deep dive in. And then two other points. One is on the next slide, please. Down at the bottom of this slide is something that really is important for this slide. The SBA, why they did this, I don't know, because I guess it's political correctness run amok. They originally limited the ability of larger lenders to participate in the new revised PPP programs, and that went away on Tuesday, January 19th. So now everybody can get involved in the new amended PPP program and the small draw PPP program. And then something which you really need to hold on to in the next slide, and that is, here are the forms and here are the websites which list all the innumerable PPP interim regulations, because even though the PPP, the SBA issued 2 interim regulations. The other 20 odd interim regulations are still in force. So you've got to be aware of them to the extent they're not counteracted by the most recent 2. And our strong advice to you is if you're making loans under these programs, you have to check these websites every day because things really have a tendency of changing on a daily basis the way that the SBA does business. Having said that, I will turn it back. Well, I'm going to turn it over to Ken, who's going to talk about some issues that are currently on the table with the program.
Great. Thank you, Joe. Appreciate that. Very thorough. On this slide, as you can see, we're going to talk about the practical considerations under the original PPP and the second or small draw PPP. Before we dive into that, I think it's appropriate to mention that the Main Street Lending Program has ended essentially. At least there's no ability to get a loan under that program as of the end of the first week of earlier this month. But there's nothing under the new legislation that modifies the ability for an entity that actually participated under the Main Street Lending Program to actually also get a PPP, including a second draw under the PPP. So that's important to keep in mind. There's nothing there that would prevent a company that has also taken advantage of the Main Street Lending Program from taking advantage of the PPP as renewed here. That's probably the most pertinent and important piece to mention with respect to the Main Street Lending Program because it is no longer available. And with that, let's go ahead and talk about some of the practical issues that we're already starting to see in connection with round 2 or the small draw PPP. To begin, it's appropriate to highlight that the interim final rules that have come out, one has come out and it's rather lengthy and it addresses the original PPP as modified by the recent legislation. There's also another IFR that has come out and addresses the second draw PPP. But what is clear in the second draw IFR is that if it doesn't speak to the issue directly, then all other regulations and guidance, including FAQs, remain applicable to the second draw or small draw PPP. And so that's an interesting way to implement the second draw. And I think it makes perfect sense because there's a lot there, and there really is a backdrop that needs to be in place. But interesting questions are arising. One area it's worth highlighting is under the M&A space, merger and acquisition space, where you have a transaction where you have one company buying either the equity or the assets of another company, but the target happens to have a PPP loan. Originally, there was a great deal of confusion around this at the outset because of the way the SBA 7A loan program is structured. The PPP, mind you, was layered in over the SBA regulatory landscape, and it was done so for expediency. Otherwise, it probably would have rolled out much like the Main Street Lending Program. It would have taken months for the rules to be developed. If you can recall, if you were tracking both programs, one took off within a few days, the other one took several months. And so there was some, reason behind looking to the SBA regulatory landscape for the PPP, but interesting issues arose. And one had to do with this notion of a change of ownership. Under the prior SBA landscape outside of the PPP world, the change of ownership really did impact any change in the cap table. And importantly, the lender needed to give its consent to that kind of a transaction, and the lender in turn needed to obtain the SBA's consent to that type of a transaction. If a lender had not done that, it could jeopardize the guarantee that it was relying on by the SBA. Interestingly enough, under the PPP, the promissory note that was suggested by the SBA did contain a restriction on a change of ownership. But if you recall, lenders were not required to use the SBA form promissory note. They could use their own note. And indeed, many did. There were probably tens of thousands, if not more, loans out there that were documented with a promissory note that didn't speak to a change of ownership. And so you had this really interesting world where, contractually speaking, you had many lenders that have participated in the program weren't able to prohibit or prevent a company from allowing a change of ownership. And in the cases where the change of ownership was in fact in the promissory note and restricted the PPP borrower from engaging in that kind of transaction, it wasn't clear what the implications were, because the implications under the SBA guidelines at that point were merely consequences against the lender, i.e. the lender could lose its guarantee. There was a lot of uncertainty as how that impacts the guarantee that the PPP borrower was relying upon. And there was actually more to this. There was many layers to this, but I'll stop there at that summary. And in sum, let you know that the SBA had to address this. They came out with guidance in early October to give some additional color around this because it needed to be addressed. So why does that matter here? Well, the change of ownership concept still remains in play. If a company got an original PPP, and if they were contemplating participating in some kind of a merger or acquisition transaction and they are the target, SBA approval is needed unless a couple things are established. One, the PPP funds are fully spent prior to consummating that transaction, and a loan forgiveness application has been submitted. And two, an escrow has been established in the amount of the principal amount of the PPP loan to be set aside in case of anything short of full forgiveness of the loan. That remains in place today. And when it comes to the second draw PPP, that concept continues to remain in place unless we hear differently. It is important to note that in the second draw interim final rule, there is a footnote that says additional FAQs will be published to address some of the ambiguities that are being found. It's unclear whether they'll just simply rely on the guidance that was put out under the original PPP to be equally applicable to the second draw. I suspect that is the case. So for now, I would assume that if you're a company that has a PPP, has fully spent it, perhaps you've even submitted for loan forgiveness, you're contemplating a second PPP under the small draw, that you're going to be required to live with the same change of ownership restrictions under the original PPP. And importantly, under the underlying guidelines, it's a 12-month period from the latest disbursement. So think about that for a moment. If you happen to be one of the first PPP borrowers back in April of 2020, your 12-month timeline is actually going to be running out here in just a few months. If you get a PPP round 2 loan, you now reset the clock. So there's some implications there. There's also some interesting issues whereby a company may very well be in a position to have to establish 2 escrows, right? If the first PPP loan has not been forgiven for whatever reason, it's in limbo. And there has been a second PPP that has been fully spent and an application for forgiveness submitted. But in any event, there is an acquisition to be consummated. Right now, until we get further guidance, you'd have to assume that there'd be a need for 2 escrows to be established. As for other M&A related issues, one thing to be careful about under round 2 is all of the same certifications under round 1 are present. Even the affiliate analysis remains pertinent. And what we're finding is there are some companies that got a PPP in round 1 and now they're taking a look at the second round, but they happen to be under an LOI with another company contemplating some kind of an M&A or a merger of some kind. Importantly, the SBA takes LOIs very seriously. And if there's enough terms in the LOI, the important ones being applicable, meaning the purchase price has been established, most of the material terms have been determined, and perhaps the consummating of the transaction is merely subject to additional diligence and documenting the actual transaction itself, that can implicate an affiliate relationship. And it will completely change the analysis for those companies that are in that situation. So be mindful that if you're looking at round 2, and if you have an LOI in place, you may very well have to take a step back and make the determination of whether the acquiring entity happens to be an affiliate, and how does that affect the numbers. Another interesting development we're seeing is there have been a few companies out there that we've seen in our client base that happen to do a restructuring of some kind, or for whatever reason, they've changed their EIN between the application of the original PPP and the second draw. And as they're going to complete the second draw application, they're finding that there's essentially a new EIN, and it appears to be a completely new entity that is actually looking to obtain the second PPP. There's a lot of uncertainty around that. We do know that the SBA is concerned about the original PPP loan number and also the EIN that was used by the original PPP borrower. To the extent there's a disconnect there, we suspect there could be some problems, but it's yet to be seen how that's going to be handled. It's unclear. Ideally, the FAQs that will be coming out can address that type of issue. So that's something to watch out for. As for the needs-based certification, this is a really interesting one because the IFR in connection with the original PPP that was most recently published speaks to this issue directly. It makes it clear that if the loan is under $2 million, then there's a deemed good faith by certification by the PPP borrower that they needed the loan. If you recall the original PPP and how much heartburn there was around that particular certification, there was a great deal of emphasis and activity such that they needed to come out with an FAQ that essentially made it very clear to the business community, yes, we understand that this is very vague or ambiguous certification, but here's how we're going to handle it. If your loan's under $2 million, we're going to just deem that certification to be made in good faith. If it's over $2 million, we're going to take a closer look. There's going to be an automatic audit. And if you lacked an adequate basis for making that certification, we may require the loan to be repaid. That remains in place. Interestingly enough, PPP round 2 has a max dollar amount of $2 million, right? And so there's an interesting ambiguity of, what if your loan under round 1 was $1.5 million, and now under round 2 it happens to be an additional $1 million? You're now at 2.5 collectively. There isn't anything in the regs that actually distinguishes between round 1 and round 2 for reaching that threshold. So it's unclear whether those companies are automatically going to be slotted in to the 2 million and above. Also keep in mind when it comes to that analysis, it's not just 2 million for the one particular PPP borrower, but also the affiliate group as well. And so you have to aggregate all the loans of the affiliates of that PPP borrower for purposes of this deemed good faith certification if you're looking to stay under the $2 million mark. As an aside, it is worth mentioning that the aggregate cap for the company group for round 2 is actually 4 million, not the 20 million that was in place under round 1. So, you're dealing with smaller numbers all around, but it may be something that is important to track nonetheless. And aside from all of that, irrespective of how the SBA has decided to handle that particular certification, that the PPP borrower actually needs the funds for ongoing operations, that's the SBA's decision to not be overly aggressive, if you will, with that particular certification. But there's no guarantee other government agencies won't pursue companies for not taking that certification seriously. And there's also private parties under the False Claims Act that could pursue a particular PPP borrower for not taking that certification seriously, even under round 2. So that's a caveat that must remain present when you're making the determination as to whether to participate in round 2. As for eligibility discrepancies, what we're finding here is there's some interesting disconnects between round 1 and round 2. And Joe made mention of some of the eligibility differences. And it is a little curious, as you can see how the act was passed and structured. You have this subset of eligibility, requirements that exclude certain entities under round 2, but actually wouldn't perhaps exclude those entities if they were just first coming to get an original PPP. A good example is lobbying activities or companies that happen to be controlled by companies associated or organized in China, for example. Interesting the way the regs look today, and I hope the FAQs speak to this, but it looks as if the company hadn't gotten a PPP under round 1, but they happen to be ineligible under round 2. That doesn't necessarily push them out of round 1. In addition to that, you're having very interesting situations where companies were in a group of PPP borrowers. And if you can kind of go back and envision the original chaos that surrounded the program, there was a lot of uncertainty as to how these loans should look. Who is the borrower? What, is there a borrower group per se? And so there was all sorts of different ways companies got access to the original PPP. And it wasn't uncommon for them to group companies under one application, for example, as long as they are otherwise eligible. And now you have situations where there's eligibility issues with respect to one entity within that company group, but perhaps not the other entities. And so there's some interesting confusion as to whether that prohibits the entire company group from having access to round two, or just those that are ineligible for their own particular reasons. We do know that when it comes to the gross receipts requirement under round two, that there is a requirement that the company groups and the affiliates aggregate their gross receipts. So if you had a situation under round one where you said, let's say you had 4 or 5 companies under one PPP loan, come round two, it so happens that only 2 of those 5 happen to satisfy on an individual basis the gross receipts reduction, for the quarter by quarter basis comparing 2020 to 2019. No matter, the rules will require the aggregating of the gross receipts for the entire affiliate group. So that's interesting. So there's going to be some disadvantaged treatment, if you will, of certain companies that would otherwise maybe have qualified unilaterally under round two, but are going to be prohibited under round two because of its affiliate relationships with companies that are performing better than that particular prospective borrower. Another ambiguity we're finding is the accounting treatment. There's been a lot of questions around the gross receipts requirement, and the SBA has put out some guidance there. Essentially, it's really money in the door. The real question is, can you get creative with the accounting? As a law firm, we direct our clients to their accountants to answer how creative they can get. But one interesting kind of surface level issue I've run across is that the guidance says that either the accrual or cash method is acceptable, whichever that particular company is using. It's not uncommon for companies to have a cash method during the year, for example, for its own internal financial statements. But then when it comes to an audited financial statement, it is using the accrual method, for example. And so now there's questions as to, can a company pick and choose the accounting method when it actually matters? That to me is an interesting question. Ideally, it's addressed. My only guidance in those cases is, what is a good faith application of the accounting method? If it's a quarter 2 or 3 compared to in 2020 compared to 2019, and you otherwise do a cash accounting for that particular quarter, it might be good faith to simply stick with that particular treatment. And so ideally, we can get a little bit more guidance on that, but time will tell. The last item that's worth talking about is the under review concept that's at the back of the second draw interim final rule. And this has to deal with companies that have a PPP round one, and they have either submitted for loan forgiveness or they haven't yet, but for whatever reason, it's still out there, hasn't been fully forgiven or addressed in one way or another, and they're interested in obtaining a loan under round two. Now, the requirements are that the round one loan gets fully spent, right, but not fully forgiven. And so that question has come up a couple times. But what is interesting is when a company goes and submits for loan forgiveness under round one, that's essentially the quote under review process that the IFR is speaking to. At least that's what we're seeing in practice. So what we're finding is companies that happen to go ahead and move forward with submitting their loan forgiveness application under round one and have yet to receive a determination, which is common because it's taking many months in some cases. I think the quickest I've heard of a loan forgiveness application being returned and the loan forgiven in full was 3 weeks. And it can, the back end of that is many, many months, depending on how much time the SBA needs. So be mindful, there could be a very large gap there. But we're finding that if the loan has not been forgiven, but an application for forgiveness submitted, that's essentially in the under review stage. Even if there isn't any reason for the SBA to decline or deny an application for round two, practically we're seeing that happen. And so that to me is a little worrying, because there's a great deal of companies in that category where they've decided to move forward with loan forgiveness under round one. And it could perhaps, if it goes beyond March 31, 2021, prevent them from getting access to round two. So I suspect the SBA is tracking this issue, and we hope that they can have some kind of a solution so it doesn't end up inadvertently boxing out many companies that otherwise truly do need the funds under round two. But that's something to be mindful of as well. So with that, I'm going to go ahead and turn it over to my colleague, Matt, to talk about some of the bankruptcy considerations.
Great, thanks, Ken. So there are a myriad of changes that the Consolidated Appropriations Act made to the Bankruptcy Code, and some other tweaks that the Biden administration and the Trump administration were making on other CARES Act programs. So go to the next slide real quick. The first is that the eviction moratoriums and the other loss prevention programs are being extended. The CD by statute in the Consolidated Appropriations Act, the CDC's moratorium on evictions was extended through the end of January. The CDC has since extended that moratorium to the end of March. And then the Federal Housing Finance Administration, I'm sure many of you know, has extended their loss mitigation programs through the end of February currently. And of course, as the pandemic continues to rage, it's likely that those will get extended out even further. One of the things in the Consolidated Appropriations Act that had a lot of bankruptcy attorneys, I think, excited was the idea that PPP loans might be made available to debtors in bankruptcy. When the CARES Act was first adopted, there was a lot of litigation about whether or not the SBA could deny a debtor in bankruptcy access to the PPP program. Those were largely resolved in favor of the SBA. Congress then, in the Consolidated Appropriations Act, made this change to the code that specifically authorizes certain types of debtors. So these are small business debtors under subchapter 5, debtors in chapter 12 cases, which are family farmers and fishermen, and then debtors in chapter 13 cases, to the extent they're operating a business, could obtain a PPP loan. The caveat is that it's only if the SBA agrees. That is, these amendments to the code are only effective once the SBA adopts, or excuse me, sends a communication, written communication is how it's characterized in the statute, to the Office of the United States Trustee, saying that debtors in bankruptcy can take advantage of these provisions. After the passage of the Consolidated Appropriations Act, the SBA's interim final rule actually resolved this question in the other direction. They said they affirmed their position that debtors in bankruptcy won't be able to obtain these loans. Now, it's an open question to whether or not the Biden administration and any changes in leadership in the SBA will reverse course on that issue, but we haven't seen it yet. If these amendments become effective, the two high points to keep in mind is that the court is required to hold a hearing on the application for the PPP loan. It's like a motion to incur debt in any other bankruptcy context. The tweak is that the bankruptcy court will be able to grant final relief on just 7 days notice, which is particularly unusual. The second component is that the PPP loan, to the extent it's not forgiven, will be given super priority status in the bankruptcy claims process. Although it can be repaid through the plan, so priority claims are typically have to be paid on the effective date of any bankruptcy plan. The code here will allow for that loan to be repaid or according to its terms. Other important changes to the bankruptcy code, stimulus payments that are being made to individuals are not part of the bankruptcy estate. So if a debtor files for bankruptcy and they still have, or they received shortly before they filed, a stimulus payment, the bankruptcy trustee and creditors cannot look to that money to get repaid. Chapter 13 debtors, typically under prior law, were required to be current on their home mortgages in order to obtain their discharge at the end of the case. Now they're allowed they can be up to 3 months delinquent on their payments and still obtain their discharge. They're not, the discharge doesn't forgive those outstanding payments, but the debtor can otherwise obtain their discharge and then make the payments after the case is closed. The CARES Act assistance cannot be denied to an individual because they are in bankruptcy or because they filed a bankruptcy previously. So if someone is in a bankruptcy case or has filed a bankruptcy case before, they still get the benefit of those CARES Act deferrals and loss mitigation efforts, notwithstanding that bankruptcy. An important amendment here has to relate to these deferrals under the CARES Act. Now lenders are permitted to file a proof of claim in cases where they have these losses that relate to the loss mitigation efforts. So if there's payments that have come due during the 12-month period when a borrower is not required to make payments because of a coronavirus-related financial hardship, you can file a proof of claim in the bankruptcy case for that loss. The proof of claim is due 120 days after the end of the forbearance, rather mitigation. And then the Chapter 13 plan can be amended by either the debtor or creditor or the bankruptcy trustee in that case to provide for the payment of that claim. And you may recall that previously under the CARES Act, Chapter 13, which normally had a 5-year repayment period, in certain circumstances can now be, that repayment plan can go into 7 years. On the next slide, we talk about one of the other kind of high point changes here. To the extent you have borrowers who are landlords, their tenants will now have additional time to make payments under the bankruptcy code for rent. So unexpired leases of non-residential real property, debtors in those cases normally only had 60 days in order to get their affairs in order and begin making payments to the landlord. Subchapter 5 debtors, again, these are small business debtors, now have an additional 60 days, so a total of 120 if they have a COVID-19 financial hardship. All debtors in bankruptcy now have a 210-day period in which they decide whether or not they're going to assume or reject non-residential leases. They can then further extend that in 90-day increments the first time without the consent of the landlord, and then further increments after that with the consent. So it really gives a lot of small businesses or tenants a lot more room to maneuver in a bankruptcy case. One of the other important things here is that, particularly for the small business debtor, that deferral on the rent for up to 120 days is going to be particularly valuable, because that claim for rent during that 120-day period can then be paid under the bankruptcy plan. It's not going to be due on the effective date of the bankruptcy plan. And because small business debtors are required by law to propose their plan within 90 days of when they file the petition, it's likely that a lot of debtors will take advantage of that, excuse their rent, and simply amortize it out over the life of their bankruptcy plan. There's a new preference defense been created in the code for certain payments that relate to rent or goods and services, to protect parties that deal with debtors fairly here from being subjected to a preference claim by a trustee down the road. the key here is, again, it has to be for rent or for goods and services. It also has to be pursuant to a written arrangement where there's a change in the terms. If the debtor simply doesn't make a payment and you accept it late, that's not going to provide you with a protection. And the amended arrangement can't increase interest or other fees and costs. There's a couple other miscellaneous changes, additional protections for individual debtors, for utility disconnections, and also new priority rights for people who pay customs duties on behalf of debtors. Those are all detailed, I think, in the handout. One thing to note here of particular importance is that the temporary increase in the subchapter 5 debt ceiling, it hasn't been extended. Subchapter 5, when it's originally enacted, had about a $2.7 million debt ceiling to limit the eligibility of companies. The CARES Act extended that for 1 year to 7.5 million. The Consolidated Appropriations Act did not extend that sunset provision. So at the end of March, roughly, right now, the subchapter 5 debt ceiling will snap back down. It's unclear if Congress will further extend that number or not. And those are the high points of the bankruptcy changes from the Consolidated Appropriations Act.
Joe, we have a few more minutes. Is there anything you want to add about anticipated legislation changes with the new administration?
I think we can anticipate that there will be changes. The new administration is being very, very aggressive in coming up with programs which are going to aid in the COVID stimulus and the economic downturn. I think that's going to be it's going to be upcoming. Whether or not that also means executive actions and directions on the part of the SBA to perhaps interpret their provisions more liberally. I mentioned a while ago, and I think Ken mentioned this as well, in the websites. Check them on a daily basis and see what's upcoming. We will be able to be posting again significant changes on the Dorsey website on economic stimulus, and so again, it will probably be occurring over the next 6-week period.
Great, thanks, Joe. To the extent that your borrower is eligible or you know somebody eligible for a PPP loan on the second draw, we certainly recommend you get those applications in as soon as possible for the reasons that were noted. Thank you all so much for attending today. If you need credit, please return your sign-in to attendance@dorsey.com, and certificates will be sent to those who completed the form. And to the extent that you have any questions, we'd hoped we'd have a little time for questions, but there was so much to get through today. Please feel free to reach out to any of the presenters. They would be happy to help you with any of your questions or any of your trusted Dorsey contacts. Again, the speaker presentation materials were included on the Dorsey website. So to the extent, again, you have any questions or if you need an email copy of the presentation, again, don't hesitate to reach out to anyone. Thanks again so much.